It's not an accident that the most euphoric periods in the market's history, all four of them really, 1929, 1972, tech bubble of 2000, the great financial crash, 2008, and you could add 2011, December. Those are the five euphoric points. And the first four, it's not an accident. They're all followed, not by the best economic times and the best market returns. They are followed by the four worst economic setbacks and the four worst periods of stock market return. What a strange coincidence. We all learned at business school that high PEs are meant to be reflecting the best possible future. And what we find is the highest four PEs, highest amount of euphoria, are precisely followed by the four worst economic outcomes. The Great Depression, the Great Recession of 73, 74, the worst since the Depression, the crash and the recession after the tech bubble burst, and the real moment of truth when the great financial crash occurred, when the whole financial system of the developed world teetered on the edge of total meltdown. What a strange paradox that the market's predictive power is precisely, perfectly the opposite of what we were taught. This is unique. Two fairly distinct events, one merging almost into the other. We had a classic bubble in every way, perfectly ordinary in context of the other four in 2021. And melting down the first half of 2022 was the worst market for stocks and bonds since 1939, the year after I was born. That's quite a long time. And then in November of that year, October or November, when they introduced chat, a handful of stocks that happened to be very large, that had a future that they could relate to AI, took flight. The rest of the market drifted lower, as a matter of fact, for another 10 months. And all of the gain, plus a little, was in the hands of the Magnificent Seven, all of which had an AI story to tell. And then finally, impressed by this steady advance, and also impressed by AI itself, the broader market jumped on board in late 23, the other day, really. And we had a broader market advance. So this is unique, as if you came in 1932 with some magnificent new invention, some really cheap fusion or something. And AI is serious. It will change everything. And therefore, it's not surprising the market took it seriously. The bigger the new idea, the bigger the new invention, the more the market becomes overpriced, the more it attracts euphoria. It's not accidental. Really great things happen in the internet phase, 98, 99, but they overdo it. They overdid it with the canals, apparently, in England. They overdid it magnificently all over Europe, particularly the UK, but also the US with railroads. They were spectacular bubbles. Now, the canals were huge. The railroads were even much more profound, changed everything. They were serious. But that didn't stop them attracting too much capital, charlatans, putting 8 different railroad lines between Manchester and Liverpool, or planning them and raising capital for them, when 1 or 2 was clearly enough. And the result was a bubble that broke for canals and railroads, and then somewhat the same with automobiles and radio and so on in 1929, electrification of everything and development of mass markets for a lot of them. And then the internet. The internet was serious. We all use the internet. We can't live without our iPhones. And yet it was overdone. Everyone knows that Amazon went up multiple times in 99. It was the star of 99, which was a great year to be a star. And then in the break, it went down 92%. Very few people realize that. Amazon, huge success, went down 92%. And then it rose from the wreckage, as did a handful of them, and inherited the earth. How many, what fraction of those stars of 99 survived? I think 80% of the internet stocks just ceased to exist. Some were bought for scrap iron price. Basically, they ceased. And a handful of super leaders emerged. So the fact that it's a real idea doesn't say that there won't be a crash. It's quite the reverse. The more important the idea, the more guaranteed almost it is historically that it will attract too much short-term attention. Then there will be a crash, and then the railroads will change the world, internet will change the world, AI will change the world. But it would be classic for it to be overdone. That's what the history book is shouting at us. And to have that come in the middle, if you will, in the middle of a genteel, old-fashioned bubble forming and breaking, is to create a very novel and complicated twist. But it happens. That's what life is all about. Every now and then something really weird happens. And this is it. So where do we go from here, I think, is back to the history books. When you have these great developments, they overdo themselves in the short term. They crash in the intermediate term. And then they come out of the wreckage and change the world in the long term. And that's what I expect will happen this time. Look at the rules of thumb, basically, is what they are, that have been associated with previous recessions. And everyone knows them as well as I do. But the leading indicators are extremely good. The interest rate spread between the 6 months and 10-year and so on. And even the rising unemployment. They have very strong associations with recessions. I don't think anyone's really established the whys and wherefores, but we can see the association. I have no great insight as to whether the reason that they're associated is cast iron or not, but I can see the relationships. Whenever they're lined up like this, you have a recession. Now, I do have mild and obvious insight, if that's not a contradiction, into why it's dragged on so long. And that's the $3 trillion extra from the amazing COVID stimulus program. And what we found is the $3 trillion didn't disappear very quickly. It sat around in individuals' war chests, and it got to recycle. And yes, it's pretty darn small now, but it extended this cycle and extended it and extended it. So we were used to earlier times. We didn't have much. We had no historical experience with a stimulus of this magnitude. This was like a major war. This dwarfed the great financial crash, which was really a matter of teetering on the edge of near total financial destruction. And this time, we did more than ever. So this is completely novel, and we have to recognize that. So you expect different outcomes. And the ability to extend a cycle by a year or two, I don't think, looking backwards, should be seen as that amazing. We can see why it would extend with extra cash, and it did. It is a major surprise to me. The housing market, in a way, on a global basis, has been somewhat similar, except in China, which is important, by the way. In America, some regions were pretty good, some were not so strong. It's been an odd market. And if you think about the nature of a mortgage, you can get some idea. You've seen mortgages fall to almost ludicrous low levels of 3% and below. And you've sensibly, let's say, locked one in at 2.8, and now back, they want 6%. How enthusiastic are you going to be putting your house on the market the way you had intended a year earlier? And the answer to that one is pretty obvious, not enthusiastic at all. And so you freeze the market. And the best proof that that is a major component is the actual house turnover rate, which dropped like a stone and stayed dropped. And the turnover in the UK, Canada, Australia, it's a uniform feature of this era. So when you change the rate that profoundly, people feel, well, I've got this great asset. I've got this 30-year mortgage, or even in the UK, a much shorter-term mortgage. It's still financially significant. So people hold on to see what will happen. And everyone tells them the rates will come down in the not-too-distant future. And so they stop moving. They change their plans, or they rent their house, et cetera, et cetera. And you create cross-currents in that are not typical. And that's what we've seen. It's not so much a strong market as a weird market. Very local, very odd, sometimes dips, sometimes recovers, and generally speaking, fairly bamboozling from my point of view. Because in the end, if you lower the rate for 50 years, you lower the real interest rate structure, you're going to increase the value of almost all capital. Farms go from a 6% yield to 3%, forests do the same. The stock market does the same. Instead of yielding 5%, which it did for 80, 90 years, it yields much less. And you would think, therefore, when you move real rates back, that it would have an effect. I have no doubt it will, but I have lots of doubt as to how long it takes to flow through the system. How long does the real rate have to be considerably higher than zero, which it was, to push back on the price of assets? I don't know, but it's almost a mathematical certainty that eventually they relate. And any long-lived asset is not worth the same with a real rate of 2% than it is at zero. And yet that is not the immediate response for some of the reasons we're talking about. They're just strange. They lose volume and they act oddly. This is like a little interim like the phony war at the beginning of World War II, where nothing seems to be happening in quite the predicted way. But in the end, basic relationships tend to exert themselves, and higher real rates mean lower asset prices.